Okay, students, I'm going to pick up from where I left off. I think I've pretty well covered most of the rest of the chapter. There's some more homework we'll go over, and we'll go over a few other things. But short-term investments, right down here, I didn't mark it up, but we've talked about it before. Generally speaking, investments are considered investing activities. So if you make an investment or you sell an investment, those are investing activities. The exception comes with trading securities, which are part of operations and considered operating activities. All right, land, we've talked about that. Buying or selling land is an investing activity. That's a non-current asset. Buildings and equipment, the same. Leases, generally speaking, leases usually fall into the non-cash investing and financing activities. If they involve third parties and money does wind up changing hands, then you have to look at what kind of activity is involved. Generally speaking, you have an investing activity for the asset and a financing activity for the debt. Bonds payable, and down here they get into premium or discount. So discount or premium, I've already covered that and explained it. They explain what I told you earlier, and that is as you amortize the premium or discount, you don't show that on the statement of cash flows, but at maturity you show back as if it's bonds you have issued and sold, so it's a debt and it's a financing activity, you show as a financing activity the repayment of the amount that you borrowed, and the difference in the discounted amount gets reported as an operating activity. Now with premiums, and they talk about that in here, as you make the payment, the interest expense is less than the amount of the cash interest you're paying. So you show the interest expense as an operating activity, and then the amortization of the premium as a financing activity. Okay, that's on bonds sold. Let's see, bonds. If you buy bonds and buy them at a premium, it's just the opposite. Okay, I think all of this I've pretty well completed. Talked about the completing of the spreadsheet. Again, the difficulty is that the accounting system is just really not set up to generate a lot of this information. So you're having to scramble and get it from the comparative balance sheets. So there they get into differences between US GAAP and international GAAP. The real big difference comes down here into dividends and interest, and dividends received under US GAAP are operating activities. Under international GAAP, they're investing activities. Same with interest received. Under US GAAP, it's an operating activity. Under international GAAP, it's an investing activity. With interest paid under US GAAP, that's an operating activity. Under international GAAP, it is a financing activity. Now, international GAAP does give companies the option to follow the same treatment as US GAAP here, but hardly any companies do. Okay, we will move on down through all of this, and we get to some more preparing the statement of cash flows, indirect method, and they walk you through that and give you another spreadsheet. And I've already explained how all this works. Comparison with the direct method, I've done that. Be sure and read it. There, I just wrote in from Accounting Trends and Techniques. That's a publication. That's why I underlined it. It reports that out of 500 companies they surveyed, 495 used the indirect method. Only 5 or 1% used the direct method. 99% used the indirect method. Now, right here, they point out the FASB strongly encourages use of the direct method, but hardly anybody does. And they try to explain reasons for it. The main reason, I think, is just why present more information if you don't have to. Also, it may give competitors information that you really don't want to give them. Let's see, there they get into the reconciliation of net income to cash flow from operating activities. I've covered that, I think, pretty well. And here we get into the homework. Now, go back to that. I do want to show you this appendix. And here you see the spreadsheet to prepare the statement of cash flows under the indirect method. And I've color-coded using the same colors I used a while ago. So you see the change in the balance. And then down here you can see how it's treated under the indirect method. I've covered that, I think, adequately. So I'm going to go back up here and we're going to finish off the homework. And then I think we'll be done with this chapter. So don't know if I'll finish it on this video or if we'll have to come back, but we'll see. So let's go to brief exercises 21, 11, and 12. And then we had 2 exercises. So there is brief exercise 2111. Sanders Awnings reported net income of $90 million. Included in that number were depreciation expense, which we're going to need to add back to net income. Loss on the sale of equipment, we're going to add that back because we're doing it, what's cash flow from operations. So we're doing the reconciliation of net income to net cash flow from operating activities, or the indirect method. Records reveal increases in accounts receivable, accounts payable, and inventory of $1 million, $4 million, and $3 million respectively. What's their cash flow from operating activities? Well, let's just look at them. So there we start with net income. We add back depreciation. We add back the loss from the sale of equipment. Accounts receivable went up, so that means that they had less cash collected than sales reported. So we need to subtract that increase in accounts receivable from net income to get to net cash flow from operating activities. Then we had an increase in accounts payable. That means that part of what was reported in cost of goods sold as an expense has not been paid for yet. So because less cash was paid than was reported as cost of goods sold, we need to add that amount to net income. We had an increase in inventory. That means we purchased more inventory than we had in cost of goods sold. So we need to subtract that from net income to get to net cash flow from operating activities. So there you have it. Now let's go to brief exercise 1112. Sunset Acres reported net income of $60 million. Included in that number were trademark amortization expense of $2 million. So that's a non-cash expense. We need to add that back to net income. Gain on the sale of land of $1 million. We need to subtract that out of net income. Records reveal decreases in accounts receivable, accounts payable, and inventory. $2 million, $5 million, $4 million. What's their cash flow from operating activities? Well, let's just go look at them and I'll explain them. So there's net income. We add back amortization expense. We subtract out the gain on the sale of land because that is reported as an investing activity, the total price of selling the land. We have to subtract out the gain to keep from double counting it. Decrease in accounts receivable, what does that mean? That means we collected more from customers than the amount of sales. So we add that. Had a decrease in accounts payable, so that means we paid off more to suppliers than we bought. So we have to reduce net income because we had more cash outflow to suppliers than we had cost of goods sold. Decrease in inventory, that means we sold more inventory than we bought. So we had less cash outflow than cost of goods sold related to that item. So we add that back, and that gets us to our net cash flow from operating activities. Okay. Now we see down here, and we're to identify for each of these whether it is a financing, operating, or investing activity, with an O for operating, I for investing, F for financing. We'll just go through those. Sale of common stock, that's our stock. That's a financing operation, transaction with owners. Sale of land, that's an investing activity. Purchase of treasury stock, that's a financing activity. The transaction with owners. Merchandise sales, that's operating. Issuance of long-term note payable, financing. Purchase of merchandise, operating. Repayment of a note payable, repayment of the principal, is a financing operation. Employee salaries, operating. Sale of equipment, doesn't matter whether it's a gain or a loss, it's an investing activity. Issuance of bonds, financing activity, we're borrowing money. Acquisition of bonds of another company, that's making an investment, that's an investing activity. Payment of semi-annual interest on bonds payable, interest is an operating activity. Payment of cash dividend is a financing activity. Purchase of a building, an investing activity. Collection of non-trade note receivable, principal amount, that's an investing activity. Loan to another company is an investing activity. Retirement of common stock, financing activity. Income taxes, operating activity. Issuance of short-term note payable, financing activity. And sale of a copyright, sale of a long-term asset, that's an investing activity. All right. Now, I'm not going to have time to go through. You're not assigned exercise 2127, but what we're going to do is use the information from that to prepare the statement of cash flows using the indirect method. Exercise 2127 uses the same information under the direct method. So I just wanted to present them both for y'all to see. So there we see the comparative balance sheets. We see the changes. They've put it in the debit and credit format. Then we come to the income statement, the same thing. And then there is the spreadsheet to prepare the statement of cash flows. And you're going to have to do that one. I'm not going to spend a lot of time going over it. But there we see net cash flow from operating activities of negative 25 million. And then under the direct method, we see net cash flow from operating activities, negative 25 million, negative 221, and positive 160, and a decrease in cash of 86 million. And same things are up here. So